All right, let's dive into this critical scenario involving Oval Enterprises Limited. This is a classic exam-style question that tests your understanding of how to handle comparative financial statements when the previous year had a modified opinion. Here is the situation. C.A. Karen is the auditor for the current year. He notices that last year's financial statements received an adverse opinion because of a misstatement in how debtors were evaluated and disclosed. Now, the key question is, what does Karen do if that issue is still unresolved?
First, you need to understand the core principle. If the prior period's report had an adverse opinion and the matter is still unresolved, C.A. Karen cannot simply ignore it. He must modify his opinion on the current period's financial statements as well.
Now, let's look at how he actually writes this in the audit report. He will use the basis for modification paragraph, and he has two options depending on the impact. Option 1. If the unresolved issue is material to both the current year's figures and the previous year's figures, Karen must refer to both periods in his description. He needs to clearly explain how the misstatement affects both sets of numbers. Option 2. In all other cases, if the issue doesn't necessarily distort the current year's figures, but makes it impossible to compare the 2 years fairly, he must explain that the opinion is modified specifically because of the effect this unresolved matter has on the comparability of the figures.
There is one more very important rule here. When comparative financial statements are presented, the auditor's opinion must refer to every single period presented for which an opinion is being expressed. He can't just talk about the current year. He must address the prior period too.
Finally, let's consider a twist. What if the prior year was audited by a different firm, a predecessor auditor? In that case, C.A. Karen needs to add another matter paragraph. In this paragraph, he must explicitly state 3 things. First, that the prior period was audited by a predecessor auditor. Second, the type of opinion that auditor gave and the reasons why it was modified. And third, the exact date of that previous report.
All right, let's dive into this case study. This is a classic scenario involving Standard on Auditing 560, which deals with subsequent events. First, let's look at the timeline. Because in audit exams, the dates are everything. C.A. Rashmi signed her report on April 19th, but on April 25th, the company gets a huge win of 5 crore rupee incentive for the previous financial year. Now, here is the critical part. The financial statements have not yet been issued to the shareholders.
Now, you might be wondering, does the auditor have a duty to keep working after the report is signed? The general rule under SA 560 is no. Once the auditor signs the report, they have no obligation to perform further procedures. However, there is a very important exception. If a fact comes to light after the report date, but before the statements are issued, and that fact is something that would have changed the auditor's opinion if they had known it earlier, the auditor must step back in.
In this case, 5 crores is a significant amount. If the board of directors wants to include this in the financial statements, C.A. Rashmi cannot just ignore it. She needs to follow a specific 3-step process. First, she must discuss the matter with management and those charged with governance. Second, she needs to determine if the financial statements actually need an amendment. And third, she must inquire how management plans to address this in the accounts.
Since the board of directors has already requested to include the incentive, the financial statements will be amended. Now, here is the professional requirement for C.A. Rashmi. She must perform the necessary audit procedures on that specific amendment. She can't just take their word for it. She needs to verify the communication from the central government and the receipt of the funds. Once she is satisfied, she will provide a new audit report on the amended financial statements. But be very careful with the dating here. This is where students often lose marks. The new audit report cannot be backdated. It must be dated no earlier than the date the amended financial statements were approved by the board. So, to summarize for your exam, because the event happened before the issuance of the statements and is material, CA Rashmi should carry out the necessary procedures and issue a fresh report, ensuring the date of the report reflects the new approval date.
All right, let's dive into this interesting case involving Mr. Roddy. This is a classic exam scenario that tests your understanding of the boundaries of a suspension order under the Chartered Accountants Act, 1949. First, let's set the scene. Mr. Raj was suspended for 2 years and ordered to surrender his certificate of practice. Why? Because he failed to check the requirements of sections 139, 140, and 141 of the Companies Act before accepting an audit appointment. Now, while he is under suspension, he doesn't just sit idle. He starts working as a data privacy consultant, filing returns and appearing before authorities, but specifically in the capacity of a consultant, not as a chartered accountant. Mr. Raj argues that since he isn't calling himself a CA in practice, he isn't violating his suspension. So, the big question for us is he right?
To answer this, we have to look at Section 6 of the Chartered Accountants Act. This section is very clear. No member can practice, whether in India or abroad, unless they hold a valid certificate of practice from the council. Now, here is where it gets tricky. If a member appears before a specialized body, like an income tax tribunal, they usually do so in their capacity as a member of the institute. If they are suspended, they cannot use their professional status to gain entry or practice.
However, look closely at the specific facts of Mr. Raj's case. He isn't claiming to be a CA. He isn't using the prestige or the title of the institute to get this work. He is acting purely as a data privacy consultant. The key takeaway here is the distinction between practicing as a chartered accountant and practicing in a completely different professional capacity. Since Mr. Raj is appearing before the authorities as a consultant and not as a chartered accountant in practice, he is not breaching the terms of his suspension. So, in your exam, if you see a similar case, remember this logic. The suspension prevents a member from practicing the profession of accountancy. It does not strip them of their right to work in an entirely different capacity, provided they do not represent themselves as a practicing CA. In this case, Mr. Raj is in the clear. Keep this distinction sharp, and you'll nail this topic.
All right, let's dive into this case study involving Skin Glow Limited. This is a classic example of a company failing to align its actual operations with its stated values, and it's a perfect scenario to test your knowledge of the Business Responsibility and Sustainability Reporting Framework, or BRSR.
First, let's look at the red flags in the scenario. Skin Glow is claiming their cream is 100% natural and chemical-free, but the label tells a different story, showing artificial fragrances and preservatives. That is a clear case of misleading advertising. On top of that, when a customer tried to complain, they found no helpline or complaint form. This means the company has failed to provide a basic grievance mechanism.
Now, when you see these specific issues, misleading product claims, and a lack of customer feedback channels, you should immediately link this to Principle 9 of the BRSR framework. Principle 9 is all about providing value to consumers in a responsible manner. The core philosophy here is that while a business exists to make a reasonable profit, it must do so by providing genuinely useful products and services.
To score full marks in your exam, you need to list the core elements of this principle. Think of these as the golden rules for consumer responsibility. First, companies must work to reduce any negative impacts their products have on the consumer, the environment, or society. Second, when designing or marketing products, they cannot restrict fair competition or the consumer's freedom of choice. Third, and very relevant here, entities must be transparent and accurate about any adverse impacts their products might have on the user or the planet. Fourth, customer privacy and data protection are non-negotiable. To score full marks in your exam, you need to list the core elements of this principle. Think of these as the golden rules for consumer responsibility. First, companies must work to reduce any negative impacts their products have on the consumer, the environment, or society. Second, when designing or marketing products, they cannot restrict fair competition or the consumer's freedom of choice. Third, and very relevant here, entities must be transparent and accurate about any adverse impacts their products might have on the user or the planet. Fourth, customer privacy and data protection are non-negotiable.
Fifth, the company should guide customers on how to use, reuse, recycle, or dispose of products safely to prevent overconsumption. Sixth, this is the big one for skin glow advertising must be honest. Companies must ensure that no misleading or confusing information is given to the customer. Seventh, there must be a transparent and accessible system for grievances and feedback so customers can actually be heard. And finally, for those providing essential services, like utilities, there must be universal, non-discriminatory access. Fifth, the company should guide customers on how to use, reuse, recycle, or dispose of products safely to prevent overconsumption. Sixth, this is the big one for skin glow advertising must be honest. Companies must ensure that no misleading or confusing information is given to the customer. Seventh, there must be a transparent and accessible system for grievances and feedback so customers can actually be heard. And finally, for those providing essential services, like utilities, there must be universal, non-discriminatory access.
So, in short, Skin Glow violated Principle 9 by lying about their ingredients and shutting the door on customer complaints. Keep these core elements in mind, and you'll be able to tackle any BRSR question with confidence.
All right, let's dive into this important case study involving M/SABC and Company. In this scenario, we have CAX, a very experienced professional with 15 years under his belt, acting as the engagement partner for DAF Limited, which is a listed company. Now, the core of this question is about SA 220, which deals with quality control for an audit of financial statements.
The fundamental point you need to grasp here is that the engagement partner isn't just a manager. They hold the ultimate leadership responsibility for the overall quality of the audit. But how does CAX actually demonstrate this leadership? It's not just through paperwork, it's through his actions and the messages he communicates to his team.
When CAX is setting the tone for the audit, he needs to emphasize two major areas. First, he must highlight the absolute importance of audit quality. This means making sure the team understands four critical things. 1. The work must strictly comply with professional standards and all regulatory and legal requirements. 2. The team must follow the firm's own internal quality control policies. 3. The final auditor's report must be appropriate for the specific circumstances of the client. And 4. This is a very crucial point for your exams. The engagement team must feel safe to raise concerns or flag issues without any fear of reprisals or backlash.
Secondly, CAX must instill a mindset in the team that quality is not optional, it is essential. It is the very foundation of performing an audit engagement. So, if you see a question like this, remember that leadership in SA 220 is all about creating a culture of compliance, transparency, and an unwavering commitment to quality. Keep these points in mind, and you'll nail this topic.
Imagine a scenario where Mr. R, A practicing chartered accountant goes to a nationalized bank manager to ask for a loan of 25 lakh rupees. Now, here is where it gets tricky. To ensure the loan gets approved, Mr. R offers a deal. He tells the manager that if the loan is sanctioned, he will file the income tax returns for the manager and the entire staff completely free of charge. Essentially, he is offering a quid pro quo, or a this for that arrangement.
To tackle this in your exam, you need to refer specifically to Clause 2 of Part 4 of the first schedule. This particular clause deals with what we call other misconduct. Now, pay close attention here, because this is a broad and powerful provision. It states that a member of the institute, whether they are in practice or not, is guilty of misconduct if, in the opinion of the council, they bring disrepute to the profession or to the institute. To tackle this in your exam, you need to refer specifically to Clause 2 of Part 4 of the first schedule. This particular clause deals with what we call other misconduct. Now, pay close attention here, because this is a broad and powerful provision. It states that a member of the institute, whether they are in practice or not, is guilty of misconduct if, in the opinion of the council, they bring disrepute to the profession or to the institute.
The most critical part of this rule is that it applies regardless of whether the action is related to professional work or not. This means that as a CA, you are held to the highest standards of integrity and ethics not just when you are signing an audit report, but also in your personal affairs. The most critical part of this rule is that it applies regardless of whether the action is related to professional work or not. This means that as a CA, you are held to the highest standards of integrity and ethics not just when you are signing an audit report, but also in your personal affairs.
In this case, by offering free professional services as a bribe or an incentive to get a personal loan, Mr. R is compromising the dignity and integrity of the profession. He is essentially trading his professional expertise for a personal financial favor. This behavior clearly brings disrepute to the entire CA community. So, your conclusion in the exam should be clear and firm. Mr. R is guilty of other misconduct under Clause 2 of Part 4 of the first schedule to the Chartered Accountants Act, 1949.
All right, let's dive into this case study. This is a classic scenario that tests your understanding of the intersection between the Companies Act and the Chartered Accountants Act. First, let's look at the facts. We have Mrs. Fair, who is a director and a shareholder in XYZ Private Limited. The company appoints her husband, Mr. Lovely, as the statutory auditor. Now, the moment you see a spouse involved in a company's management and audit, a red flag should go up regarding auditor independence.
To solve this, we need to look at Section 141, subsection 3, Clause F of the Companies Act, 2013. This section is very clear. A person is not eligible for appointment as an auditor if their relative is a director or a key managerial personnel in that company. Since the law explicitly defines a spouse as a relative, Mr. Lovely was legally disqualified from the very start. He simply should not have accepted the appointment.
But here is where the professional ethics come in. As CA students, you must remember Clause 9 of Part 1 of the first schedule to the Chartered Accountants Act, 1949. This clause states that a member in practice is guilty of professional misconduct if they accept an appointment without first verifying if the requirements of the Companies Act, specifically Sections 139, 140, and 141, have been complied with. In this case, Mr. Lovely failed in his primary duty to ascertain his own eligibility. By accepting the role while his wife was a director, he didn't just violate the Companies Act, he committed professional misconduct under the CA Act.
So, when you write this in your exam, make sure to link these 2 points. First, the disqualification under Section 141 of the Companies Act, and second, the resulting professional misconduct under Clause 9 of the first schedule. It's a straightforward application of the law, and as long as you cite these specific sections, you'll nail this answer. Keep focusing on these links between the Act and the schedules, and you'll do great.
All right, let's dive into this case study involving DOX Limited. This is a classic exam-style question that tests your ability to connect the dots between the Companies Act and the CARO reporting requirements. First, let's look at the facts. DOX Limited is a courier service provider with a turnover of 300 crore rupees.
Now, before we jump into the reporting, as a professional auditor, your first step must always be to determine if any exemptions apply. Looking at the profile, this is clearly not a small company, a private company, or a one-person company. It's not a banking or insurance firm, nor is it a Section 8 company. Because it doesn't fit into any of these exempt categories, we can confidently conclude that the company's Auditor's Report Order, or CARO 2020, is fully applicable here.
Now, the core of the question asks about the statutory auditor's reporting responsibility regarding internal audit. This is where you need to pinpoint Clause 14 of Paragraph 3 of CARO 2020. When you are drafting your report for the year 2025-26, you have 2 specific responsibilities under this clause. First, you must report whether the company has an internal audit system that is commensurate with the size and nature of its business. Second, you must explicitly state whether you, as the statutory auditor, have actually considered the reports generated by the internal auditor during the period under audit.
In this case, with a 300 crore turnover and a dedicated internal audit head, Mr. G, the company seems to have a structured system in place. So, to wrap this up for your exam, identify that CARO applies, cite Clause 14, and mention both the adequacy of the system and the consideration of the internal audit reports. Keep this logical flow, and you'll nail this answer. In this case, with a 300 crore turnover and a dedicated internal audit head, Mr. G, the company seems to have a structured system in place. So, to wrap this up for your exam, identify that CARO applies, cite Clause 14, and mention both the adequacy of the system and the consideration of the internal audit reports. Keep this logical flow, and you'll nail this answer.
First and foremost, look at the top level. We need to see active oversight and involvement from those charged with governance. This means the board of directors or the managing director shouldn't just be nodding along. They must approve written risk management policies. These policies have to be realistic. They should align with the bank's business goals, its capital strength, and the regulatory requirements. Essentially, the board needs to define exactly how much risk the bank is willing to take.
Next, we move to the actual mechanics, the identification, measurement, and monitoring of risks. CASWE needs to verify that the bank has a process to spot risks that could derail its goals and, more importantly, that these risks are measured against pre-approved limits. If a limit is breached, there should be a clear trigger for action. Next, we move to the actual mechanics, the identification, measurement, and monitoring of risks. CASWE needs to verify that the bank has a process to spot risks that could derail its goals and, more importantly, that these risks are measured against pre-approved limits. If a limit is breached, there should be a clear trigger for action.
Now, let's talk about the actual control activities. This is where the rubber meets the road. You're looking for a strong segregation of duties. In banking, the most critical split is between the front office, where deals are made, and the back office, where they are processed. You also want to see accurate reporting, rigorous verification of transactions, regular reconciliations, and a solid contingency plan for when things go wrong.
But controls aren't static. That's why monitoring activities are crucial. The models and assumptions the bank uses to measure risk can become outdated quickly. CA Swedish should check if these are regularly updated, ideally by an independent risk management unit to ensure there's no conflict of interest. Finally, none of this works without reliable information systems. The bank needs a system that provides financial and compliance data on a timely and consistent basis. The information must be presented in a way that is easily understood by management, allowing them to see how the bank's risk profile is changing in real time. But controls aren't static. That's why monitoring activities are crucial. The models and assumptions the bank uses to measure risk can become outdated quickly. CA Swedish should check if these are regularly updated, ideally by an independent risk management unit to ensure there's no conflict of interest. Finally, none of this works without reliable information systems. The bank needs a system that provides financial and compliance data on a timely and consistent.
All right, let's dive into this case study involving XYZ Limited. Here is the scenario. The company bought land in Nagpur for 10 crore rupees, but a director suspects that something is fishy regarding the price and the transaction. To clear the air, the management appoints PV Associates to conduct a formal investigation. Now, while investigating, PV Associates realizes they aren't real estate experts and they need a professional valuation to determine if the land was overpriced.
The big question here is, are they actually authorized to bring in an outside expert, and if so, how should they go about it? The answer is a definite yes. In the world of professional investigations, it is very common and often necessary for an investigator to seek the views and opinions of experts in specialized fields. Whether it is a land surveyor, a technical engineer, or a valuation expert, the investigator is fully allowed to take this assistance to ensure the investigation is thorough and accurate.
However, you cannot just hire anyone on a whim. There is a specific professional process to follow. First, PV Associates should obtain written general consent from their client, which is XYZ Limited, right at the beginning of the investigation. This consent should explicitly state that the investigator has the permission to refer special matters to various experts. Secondly, and this is a crucial point for your exams, the investigator must settle the question of costs. They need to agree with the client on who will pay the expert's fees and handle any other financial implications. By getting this in writing and settling the costs upfront, the investigator protects themselves and ensures transparency. So, in short, yes, they can use an expert, provided they have written consent and a clear agreement on the expenses.
All right, let's dive into this case study. This is a classic exam-style question that tests your understanding of the fundamental principles of professional ethics. We have 3 distinct scenarios here, and each one points directly to a specific ethical violation. Let's break them down one by one so you can nail this in your exam.